April 2025 was a momentous time in the holiday let sector, with the biggest changes to tax legislation in over 40 years, with the removal of tax benefits for furnished holiday lets. There potentially are some ways that you can restructure your business to mitigate those changes long term. If you're making a profit from short-term letting and you're paying tax, and it's still a good thing, tax is a byproduct of a successful business.
How has the Furnished Holiday Lettings tax regime changed? What does it mean for current owners and new investors? Can people still claim capital allowances? And how should property management companies support their owners who are concerned about the changes? Matt Jeffery from Zeal Tax will be answering all these questions and more on today's Host Planet podcast. Matt, thank you for joining us on the Host Planet podcast. In relation to the Furnished Holiday Lettings tax regime, what changed in April?
Hi, James. Thanks for welcoming us back on again for the podcast. And yes, obviously April 2025 was a momentous time in the holiday let or short-term let sector, with the biggest changes to tax legislation in over 40 years. With the removal of the tax benefits for furnished holiday lets. Probably first thing we should do is just clarify that if we're using the term furnished holiday lets throughout this podcast, it means short-term let or anything, a property that's let furnished on a short-term basis. So we'll run with FHL or furnished holiday let, but it does encompass all properties let on a short-term basis, and can include things like static caravans, lodges, etc. as well. So, as I've and hopefully everyone watching this is well aware that the furnished holiday let regime was abolished, but just to quickly summarise what the key things were that were removed. So interest on finance costs will be restricted to a 20% basic rate tax deduction. So you don't lose it all, you're just restricted to a 20% tax relief. There's capital allowances will be removed. You'll still be able to claim the replacement of domestic goods, which is good for furnished holiday lets because your furniture, furnishings, etc., washing machines, dishwashers, things like that. When you change those, you'll still be able to get tax relief on them. But if you're buying new ones for the first time, then you no longer get any tax relief on that. Pension, so your earnings or your profits from a short-term let, you used to be able to count them as relevant earnings towards your pension contributions. So going forward, you won't be able to do that. And then the other one is the ability to share income between owners in a tax-efficient manner. That now the rules say that joint owners need to share their profits based on their legal ownership. And then the final one was capital gains tax release. So when you sell your property and you pay another load of tax on your profit that you make, there was some release and different rates that you could use under holiday lets, and they've been removed as well. So if you sell your property now, it's just capital gains tax based on using the rates of 18 and 24% as they currently stand. So yes, quite a bit of change.
Yeah, a very big change for people running furnished holiday lets. And let's break it down then. What does it mean for current holiday let owners?
Yeah, okay. So one thing a message I'm trying to get out to the owners we speak to on a daily basis is that look, for some people, hopefully you will not see any change. If you don't have a mortgage, if you've claimed all your capital allowances, if your business is set up in tax efficient way, then hopefully you'll see no changes at all. And for those who will be impacted, potentially where you've got high interest costs, etc., then you will likely pay more tax. But there potentially are some ways that you can restructure your business to mitigate those changes long term. It's not something that can happen overnight, but there are steps you can put in place to try and mitigate that sort of impact long term.
Okay, real talk now for all you hosts out there. You know that moment when your guest messages you again with, "Hey, what's the Wi-Fi code?" Or you're staring at 5 different calendars, wondering if you've accidentally double booked the cottage. Yes, we've all been there. That's why here at Host Planet, we recommend Hostfully. It's basically your rentals control center. It handles bookings across all the big platforms, syncs your calendars to ensure there are no double bookings, automates guest messages, and even creates these really slick digital guidebooks that stop all the repeat questions. Honestly, it just makes your life easier and keeps your guests happier, helping you achieve those all-important 5-star reviews. And here is a little bonus. If you're a Host Planet listener, you can get $500 off onboarding for Hostfully's property management software and 30% off digital guidebooks for life. Just hit the link in the show notes and use the codes PLANET500 for the PMS and Host Planet GB for the guidebooks. And if you'd like a proper walkthrough, there's also a link to book a demo with Frank Bosey from Hostfully. He will show you how it all works. Less stress, more bookings, sorted with Hostfully. And for people who want to start investing in holiday lets, what are the main implications for them?
Yeah, I think that's where the biggest impact we'll see is people new to holiday letting, more in terms of the setup costs and the ability to deduct those. So historically, owners of holiday lets, FHLs, they will incur fairly significant costs to fit out your property. Things like furniture, furnishings, beds, sofas, all that type of stuff. The obvious hot tub as well, and that usually meant that owners could generate a pool of losses at the beginning that they could then use, and normally mean that you wouldn't pay any tax for the first few years. Then there's obviously the ability to claim capital allowances on potentially part of your purchase price and refurbishing costs. So those coming into the industry now who can't do that, they're pretty much going to pay tax from day one, whereas previously you could have had a bit of a period of time before you had to pay tax. So, but as I always say to people, if you're making a profit from short-term letting and you're paying tax, and it's still a good thing. Tax is a byproduct of a successful business. So, I try and encourage people not to put people off just because the tax rules have changed. But for those coming into the industry, they won't know any different as well, hopefully. So not such a major issue. If it means that there's less people entering the sector, or it's less easy to enter the sector, then maybe that's better for the industry long term. We will see. But yeah, the biggest impact is really going to be for the new people new to the industry.
Yeah, it's interesting, isn't it? I'm thinking back to when I bought my first holiday let, and yeah, obviously kitting it out, there's a lot of expense there with all your furniture and TV and beds and all the rest of it. And one thing I did was I replaced the kitchen. Now, if I'm replacing the kitchen, is that an expense because it's right at the start and you are replacing something existing? Would that be something you can claim?
Potentially, yes. Unfortunately, I can't just say yes. You can you get tax to replace the kitchen, because it does depend on. So if it's pretty much like for like, with the improvement being just in line with technological advances. So the common one I would say with the kitchen is we used to put wooden worktops on. Now people put a granite worktop on or a stone worktop. Whilst that is an improvement, that's just in line with technology. So or advances in technology. So as long as you're not taking doubling the size of the kitchen and putting a sort of stainless steel kitchen in above a sort of standard, you should be able to deduct that cost. The trade-off will be that when you sell the property in the future, you won't be able to deduct that cost of the new kitchen against your capital gains tax, whereas previously under capital allowances, you could have deducted against income tax and then against capital gains tax in the future. So it does depend. There is a guide to which will answer all those types of questions. I'm changing my bathroom. I'm going to do this or that. There is a guide on our website, and it's probably available through Host Planet. If it's not, we'll make sure it is. And that's got lots of frequency asked questions that will answer those types of questions that owners have. So yeah, there's a resource here.
Yeah, it's really comprehensive, and we'll make sure that we put a link to that in the show notes. So obviously then you're chatting to owners all the time about their situations. What are the biggest issues that owners are currently facing in relation to the rule changes?
Sure. Well, interestingly, the most common the most regular issue that we're facing on a daily basis is owners where we mentioned previously about having the joint owners having to share the profits equally, whereas previously you could allocate the profits to the lower earner, meaning that you could, avoid that 40% tax rate that maybe, one of the owners has. So it will have a big impact. If you've got a profitable business and, you were using up your one partner's personal allowance, first 12,500 tax free, and then just paying tax at 20%, it might mean that half your profits are being taxed at 40% or 45%. So we've been working with owners a lot around that and looking at ways that they can manage that. So if you're not married, so if you're joint owners and you're not married and one person does specifically operate the business, then you can actually continue to operate as you were previously. Ideally, you form a partnership, but it's not essential. And HMRC have released some new guidance recently that confirms that non-married couples, that providing that they can, evidence the fact that one person is more involved than the other, then they will be able to still allocate the profits in the manner that they've agreed as a business. If you're husband and wife, then you do need to do something. Or I should say husband and wife, married couple, or civil partners to be correct. And the things that we're looking at for those type of people are things like a declaration of trust. That's where you change the legal ownership from, I always get this, from joint tenants to tenants in common, and then you can have a simple legal document that says, our percentage shares are, say, 99% to my wife and 1% to me. And that gets submitted to HMRC, and HMRC will allow that allocation then based on that fixed amount. Now that works quite well. The costs involved in doing a declaration of trust aren't expensive. You shouldn't be paying more than £1,000 to get that done. The other options then, you are fixed with that then forever. So, or not forever, but until your circumstances change. And, you need to consider things like, does it affect your mortgage if you've got a mortgage? And, there are obviously legal issues that, as tax advisors, we can't comment on, but you do need to just double check those things, check with your mortgage broker, check with the legal advisor, just understand your position. But if you're married, changing the legal ownership shouldn't really make too much difference. The other options then are forming, so a husband and wife can actually form a partnership. I know I mentioned just then about non-married partners, but if you are married and there is one of the spouses is the person who runs the business, it just happens that the other one is a joint owner, then you will need to commercialize that partnership. So you have to do the things that HMRC would expect to see from a normal partnership. So that would include a partnership bank account, partnership agreement, partnership tax return, partnership accounts, all those things. And if you do that, then that will enable you to allocate the profits in line with what your partnership agreement says. But when you compare that option against a declaration of trust, whilst year one, the cost might be similar, year two, year three, year four, you've got the same costs of doing your partnership counts, doing your partnership tax return, etc., that you don't have with the declaration of trust. There's more flexibility to it doesn't have to be 99%, 1% each year with the partnership, but it is more costly, So a lot of people are favouring the declaration of trust as opposed to the partnership. But, there might be, for some owners, there might be a wider reason to go to a partnership. So, for instance, bringing some children in that maybe want to work in the business long term or working in the business now. So, there's not a straight answer for everyone, but the declaration of trust seems to fit for a lot of people.
Yeah, I think that's an important point, isn't it? That everybody's situation is different, and you can only really get tailored advice if you make a call and get in contact with you guys so they can run through absolutely everything.
Yeah, exactly. Don't take advice off Facebook. What was it someone said to me the day? So when people are taking tax advice on Facebook, it's like if it were electricians, everyone would be on fire by now.
Yeah.
I probably haven't said it exactly right, but that was the gist of it. The other thing we're coming across, obviously, a lot of people are struggling with changing over the business rates. there's a big backlog with the Valuation Office Agency. That's who you apply for to switch from council tax to business rates. We're seeing 6 to 18 months delays on that. So, very frustrating for owners having to pay double council tax while they're waiting for their application to be processed. My message to them is to keep on to the VOA, make sure they're aware that it's causing you financial hardship, and speak to the council to see if they will freeze the payments while you wait for the VOA to process your application. You will get any council tax back refunded to the point that when you qualify, but it is causing quite a bit of distress for owners because the payments have doubled or tripled in some people's cases.
Yeah, it is quite a hardship, and it can make your business unprofitable, really. I think that's part of our advice at Host Planet. We say get yourself onto business rates ASAP, and I've been through this myself. And one thing I will advise to people, if they are struggling, write to your local councillors, write to your local MP, because that might speed the process along a little bit. So try and pull all the levers at your disposal. All right then, so in terms of mitigating your tax bill, one of the ways you can do this is through capital allowances. Now, you can't claim from now capital allowance if you're new into the holiday let space, but if you've been up and operational for a while, you still can. And maybe this is one of the misconceptions. So explain to exactly what capital allowances are and how long have current owners got to make a claim?
Yeah, sure. So capital allowances are essentially a form of tax relief for assets that you use in a business. It's referred to as capital expenditure. For holiday let owners, as we sort of already alluded to, things like your furniture, furnishings, hot tub, etc. They're the types of things that qualify for capital allowances. But there's also an additional level of capital allowances for the embedded fixtures that you either purchase with or install in your property. The common examples were, we've mentioned a kitchen already, but kitchens, bathrooms, electrical systems, heating systems, your water disposal pipe work, waste disposal pipe work. I always say the doors and windows don't qualify, but the handles and hinges do. So just to give you an idea of that. So yes, there is this extra level of capital allowances that often gets overlooked on the purchase price of your property. So, I've just for this call, just come up and spoke to an owner who had a rental property that they purchased 10 years ago. They've been holiday letting for 3 or 4 years, and they were completely unaware that they could actually claim part of the purchase price of the property that they bought. And actually, it's going to, we just done the figures, they're getting £7,000 back, and they've eliminated the payment they've got to make this month as well, and obviously they got their future savings. So those people who, as you said, started holiday letting before April 2025 and purchased their property or paid for their refurbishment costs, etc., before April 2025, then there is a window of opportunity still to make a claim for capital allowances. The claim needs to be made in your 24-25 tax return. We're talking about individuals now at the moment. And that return needs to be filed by the 31st of January 2026. But there will be a 12-month period to amend that tax return until January 2027. So still a nice window of opportunity. And the big joy with it is that when we get to next year, owners who've got long-term buy-to-let income as well, they'll be able to use the capital allowances against them as well. So it just amplifies the benefit of capital allowances. So for individuals, the hard deadline is January 2027. But if you're already paying tax on your holiday let profits, then you want to do it as soon as possible so that you can go back a year. For limited companies, your deadline will be sometime early 2027, but it will depend on your year end of your company. So you'll have to check that. But again, the rules are exactly the same for companies. You have to have started before April 2025, and you have to have incurred your expenditure before April 2025.
If you do claim your capital allowances and then decide to sell the property, can those capital allowances be offset against the capital gains tax bill?
Yeah, unfortunately not. you can't use the losses against, because they're income tax losses. Well, for individuals, no. For a limited company, potentially you can. So you can potentially set against chargeable gains if you own the property in a limited company. But for individuals, unfortunately, those losses or the capital allowances can only be used against property income. So you can carry them forward indefinitely. So if you've got long-term lets, etc., you can still use them. So that's one of the advantages of the changes, because previously any capital allowances or losses from furnished holiday lets were always ring-fenced and only used against holiday lets. But from this tax year, we can actually use them against everything. So there's a plus side to it.
So even if you sell a property and you've got some capital gains, capital allowances in the bank, you may be able to use them against a future purchase.
Yeah, exactly that. Yes, exactly that. Or other property that you've got. Exactly, yeah.
So if we look at an average property then, and in the UK, the average price is not too far away from £300,000. So how much would you expect to be able to claim in terms of capital allowances in this scenario?
Yeah, sure. It's quite a typical example. The percentage of a property that will qualify, of a property purchase price that will qualify, there are variables. We normally quote between 15 and 30% of a purchase price, but things that will affect that range will be, the location. So land values will differ, from central London to South Wales. The type of the property it is, all these different things. So let's take an example of the 300,000. Let's say 20% qualified. So that would mean that £60,000, 300,000, 20% is £60,000. So that means that £60,000 of holiday let profits are not taxable. And so that will save you £12,000 to £24,000, which is quite a standard example of the types of claims that we do. And if you paid £12,000 in tax last year, then you'd be able to get it back.
All right, superb. Okay, then. So what should businesses who've got clients in the holiday let sector be doing to help their owners with these changes?
Yeah, I think it's really important that those businesses with clients in this sector are doing everything they can to support their owners. Believe it or not, one, they might not have accountants, and two, their accountants may not be specialists in holiday lets and fully aware of the changes and the opportunities prior to the deadline. So we encourage all owners we encourage all stakeholders in the industry that have clients or contacts to maybe work with Zeal and make sure that your owners have got all that information that they need to make sure that they're doing the things that they need to do now to help them mitigate their tax long term. They will only thank you for it. Going that extra mile and thinking about your clients. Our experiences with the partners that we work with, that they strengthen their relationships with their owners. They make sure that they're getting the maximum return on their investment, because if they're paying less tax, their ROI is better. And there's also a financial reward for introducing clients to Zeal. So we've got a whole host of information available through our hub that we can make it available to businesses to share with their clients. And the feedback is always really, really good. And businesses like to work with us as well. They see the value in helping their owners. So yeah, don't assume that they know everything, and make sure that you highlight the things to them.
Absolutely, yeah. And there's plenty of advice on our website as well, and we're directing people through to Zeal. As we said before, first thing to do, give these guys a call, drop them an email, and organise that first meeting. Okay, then, Matt, what advice would you give to any owners out there who are just feeling a bit worried and overwhelmed about all these changes?
Yeah, my message is, please don't panic. Get some good advice, check your position. It might be that it won't affect you at all. And plan ahead. That's really important. Don't wait for things to happen and then panic. If you look, there's a window of opportunity now to organise your affairs in a most tax efficient manner. So yeah, and as you said, where anybody who's listening to this webinar today, if they if they mention Host Planet, we'll happily give them a free 20-minute consultation. You can email us at hello@gozeal.co.uk. As I said, mention Host Planet, and we'll arrange a 20-minute call with myself or one of the specialists at Zeal, just to make sure you're on track and you're aware of everything.
Superb. And of course, we'll also be at the Holiday Let Success event, which is on the 11th of November in Chester, the HQ of Sykes Holiday Cottages. It's a free event, so if you want to come along to that and meet Matt and myself and ask any questions you've got, again, about capital allowances, then please do come along. Head to our website, to the events section. You'll find the link. Go to hostplanet.club. Looking forward to seeing you again, Matt.
Yeah, definitely, James. Look forward to seeing November, if not before. And yeah, as I said, if anyone wants to speak to us, hello@gozeal.co.uk or through Host Planet. There's lots of information directly to our website through there.
Superb. Matt, it's been a pleasure as ever. Thanks for joining us on the Host Planet podcast.
Thanks, James. See you soon.
Great to chat to Matt Jeffery there from Zeal Tax about the FHL changes. Remember, there is still time to claim your capital allowances and significantly reduce your tax bill. All right, that's it for today's episode. Remember, this podcast is brought to you in collaboration with Hostfully, which is trusted by short-term rental professionals across the globe. As a Host Planet listener, you get 2 exclusive offers: $500 off onboarding for Hostfully's property management software. Just use the code PLANET500, and 30% off digital guidebooks for life. Use the code HostPlanetGB. To grab these deals, click the link in the show notes or head to hostfully.com. For more free education, tips and trends from the STR industry, visit hostplanet.club, where you can sign up for our newsletter, listen to our podcasts, and download a suite of ebooks for hosts and property managers. That's it for today's episode. Until next time, happy hosting.